Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It's lecture time. And this week's topic, guys, is angle of retracement. I think there's a lot of you guys out there taking buy setups, double bottom retests, all those things, but the angle of the retracement is too steep, or it's too deep, or the quality of the retracement isn't good enough. There's too many overlapping bars. Well, today we're going to talk about the sequential pullback needed, the support areas needed, as well as when you look at a double bottom or a buy setup, not just the overlap, but the depth of retracement and the angle of retracement. So there's kind of three things that we're really going to be talking about today, right? So you're going to have that angle of retracement, not too steep. You don't want it to be too deep, like 80%, 100%. And you also want the quality of the retracement to be sequential, kind of just a little bit of overlap, but not 100% overlap. So it's a very good technical based lecture. And I think you guys are going to enjoy it because I think it's going to help you become a better trader, which hopefully will help you make even more money than you're probably already making. All right, if you like these videos, click that like button, hammer that subscribe button. I'm Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is angle of retracement. However, that's a little bit of a lie because it's more than that. It's really three big things we're going to be talking about. We're going to be talking about the angle of retracement. We're going to be talking about the level and depth of retracement. We're also going to be talking about the quality of the retracement. So there's kind of three main things we're talking about: angle, level, and depth, and quality of retracement. And remember, this isn't just buy setups. This is double bottom retests, double tops. And it's interesting, and I kind of forgot to do it, but we took that Tesla trade today. And one of the reasons we took that Tesla trade, the second trade, was the 15-minute double triple top because of the resistance to the left. And Tesla should have smacked its head in that area, and it did. But that's something, I wish I would have put in this lecture. But we're going to be talking about those three things. And they're very important because I'm finding, or generally have found through the years in trading, that the level of quality that you trade typically has a direct impact on the result that you see at the end of the trade. Now, certainly there are some times where great trades don't work, but most of the time, if you're taking a really good trade with a higher time frame bias, with a lower time frame entry, and with it timed with the market, you're usually going to be okay most of the time. Even if you have to go through a little bit of pain, a little bit of wiggle here or there, you're usually going to be okay. But I think what the problem we have is a lot of traders, they're either not looking at the higher time frame, they don't care enough about the trend, they don't care about the market, they have a lot of FOMO, and they just jump in and out of stuff because they're like, oh, that looks like it should work, or that looks strong, etc., and so forth. So you don't want to do that. So today we're going to talk about angle of retracement, level and depth of retracement, and quality of retracement. Excuse me. So let's dig into that. You guys have seen this slide before, okay? It's nothing new. It's a basic slide. It's a beginner level slide. I'm not going to spend a long time on it because I think most of you understand the basics of this level of retracements, right? A lot of people ask, well, why 50%? Other than the fact that it's the middle ground. Well, it is the middle ground, okay? But there's things you need to think about, because one of the things in trading that's always important, yesterday we talked about thinking inside the candlestick bar. Remember that conversation we had about red and green candlesticks and topping tails, and you want to put yourself inside the candlestick. One of the things I encourage all traders to do, in fact, let's jump outside of trading for a second. I encourage all people to do. When you're having a conversation with someone, an argument with someone, any type of interaction with another human being, always try to the best of your ability, put yourself in their shoes. Try to at least see it through the angle that they're seeing it through. Does that make sense? Because if you can do that, you can either better understand where they're coming from and help the conversation move forward through communication, or better understand how you might help them understand how you feel. Does that make sense? So yeah, empathy is kind of, I guess, where we're at. But in trading, we're looking to take advantage of it. See, in a conversation, we're not trying to necessarily take advantage of somebody else, although that does happen. In trading, we're actually trying to take advantage of that empathy, right? in normal human interaction, that's generally not the goal, okay, unless it's sales or something. But anyway, different topics. So where I'm going with this, guys, is, excuse me, is that you want to try to think, well, why is 100% retracement not ideal? Why is a 25% retracement not ideal? Where is the thought process for it, okay? We start at 50 because 50 is the middle ground. 100 is too much. Well, why though? Why? I mean, what's wrong with 100% retracement? There is support all the way down here at $18 to the left, and the last time the stock came down to $18, it bounced. So, Jared, in theory, the next time it goes to $18, it should bounce. Well, yes, you're correct. In theory, that's true, but there's always a caveat to everything. The question then becomes, why did it need to come down to $18 before buyers were willing to step up? Why did that car or house or clothing, why did it have to sell so cheap before it was able to find a buyer, right? You see that in weak housing markets, right? Price cut, price cut, price cut. Well, why are they cutting the price? Well, because buyers are unwilling to pay what they're asking until they finally get to a level where a buyer steps up and says, that's too good to pass up. I can't pass that up. It's so cheap, I'm going to buy it. Kind of like Nike the other day when I bought some Nike. I'm like, wow, this is so cheap, I just can't pass it up, right? So the 100% retracement is that level of thought process, and that's fine. There can be money, and there is money to be made at 100% retracement levels. However, the negative part about 100% retracement is you're not expecting the bounce to be nearly as strong, nearly as much or as big or as high as you would a 50% retracement or a 40% retracement. And the reason is you had to dig to the dregs, to the depths, you had to go so far down into the sewer to find someone, a willing participant, someone willing to buy the stock, that why would you automatically now assume everyone else wants to pile on? Just because you found one or two people willing to buy down here at 18 doesn't mean the whole world wants to continue to buy. They're seeing something different than what you're seeing. So you have to question the overall strength. Now, the only time that's not true is when we talk about climactic double bottom retests, which that's a different conversation. But when you talk about a basic uptrending pullback, which is what I'm referring to, uptrending pullback, you have to ask yourself why it needed such a discount for people to buy it. And the answer is simple, because it's not as strong as we thought. That's it. There's no other way to look at it. If it was as strong as we thought, guess what? People be jumping in at a 10, 20, 30% retracement to buy this stock at $19.50, $19.40. They'd be jumping in, which is what happened to what? NVIDIA, right? You saw NVIDIA over the last year. It was crazy. It was nuts. People didn't believe there'd be a large enough pullback, so that what did they say to themselves? The FOMO is so strong, I have to get in now, because if I don't get in now, the next level might be $21 or $22 or $23 or $24, which I hate bringing this analogy up, but isn't that really what happened to GameStop? People just didn't believe there was going to be a pullback, and it just kept going higher and higher and higher and higher, right? So that is when you have a situation where people have fear of missing out. And when they do that, they jump in earlier rather than later. When you have 100% retracement, you have the exact opposite situation. You have people going, well, I don't need to pick it up at a 70% retracement. It's probably going lower. I'll wait for 80. It gets to 80, they reevaluate. Like, well, gosh, there's no one down here either. I'll just wait for a 90% retracement. Okay? So this is why 100% retracement in an uptrend is not ideal, because you're not setting higher highs and higher lows. We have a higher high at $20, but there's no higher low at $18. It's an equal low. Equal lows do not suggest FOMO. They do not suggest buyers thinking they're going to miss out on something. They suggest patient buyers, people waiting for a discount, right? You kind of sit back and go, no, I don't need that pair of jeans today because I know next week they're going to be on sale. That's what this is about, okay? When you get the opposite, a 20 or 25% retracement up in this area, the problem with that is marathon man syndrome. Well, the stock has gone from 18 all the way to 20, right? Up, 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 up. You cannot expect something to go up forever without taking a break. The problem with a 10 or a 20% pullback is, well, it's just not a big enough break, right? It's just not a long enough resting period. And you guys know the analogy, which is why I use Marathon Man. Go run a marathon. Go run a 3-hour marathon, a 2.5-hour marathon. Go rest for an hour or two and go run another marathon. Do you think the second marathon's going to be 2.5 hours? No, you'll be lucky just to finish, right? But if you give yourself a week break, you probably run a strong second marathon. If you give yourself 12 hours or 6 hours or 2 hours of rest, it's just not enough. And that's what happens here. See, a lot of people think that, oh, well, I don't want to buy a 20% pullback because it'll fail. No, they don't always just fail. Sometimes they actually do bounce. They just don't bounce enough to make it worth our while, to make the risk to reward worth it. Now, don't get me wrong. Of course they do sometimes, but we're odds traders. I'm basing it on the overall odds. I don't want something that works 22% of the time. I want something that works 72% of the time, right? I'm going to be wrong regardless, but I'd rather be wrong less often, if that makes sense, okay? So a shallow retracement just simply isn't a long enough resting period. A too deep of a retracement questions the buyers and the strength of the buyers, which is where a 50% retracement is the perfect ideal. We call it 40 to 60, right? We give it a range. Nothing is perfect, right? It's just right, so to speak. What is it? Is that Goldilocks? Just right? Okay, so that's levels of retracement, right? Now, we're going to switch gears, all right, and move into angle and quality of retracements. Do they really matter? Angle and quality? See, we just talked about the depth, 20%, 50%, 100%, etc. But what about how it gets there? Right? What if it goes straight down? Or what if it kind of just takes its good old time going lower? Does it matter? Quality. Overlap is what we're referring to when we talk about quality. Does it matter? Well, the simple answer is yes, of course it matters. We wouldn't be talking about it if it doesn't matter. I wouldn't waste my breath. Okay, so let's talk about it. We have a couple more text slides because I know how much you guys love those. And then we're going to go all charts after that. Right? We're literally going to go like 10 chart slides after these next couple slides. Retracement levels are used to measure the strength or weakness of a move. They help us determine if the current trend will continue or likely reverse. The level of retracement helps us determine this. It also helps us determine the odds of success. We just talked about that, right? We just looked at that 20%, 50%, 100% level of retracement. So the deeper we go, the less confidence we have that a new high will be set. Let me repeat myself. The deeper the retracement goes, the lower the confidence level gets that we will put in a new high. We'll bounce. Of course, we'll bounce a little bit. But I don't want to bounce a little. I want to bounce a lot, right? That's how you make more money. So, bigger the depth of retracement, less chance we put in a new high. Okay, pretty simple concept, right? Now, in short, retracement levels help keep our expectations in check. They keep us objective. Given the prior pivot compared to the current pullback, we can surmise what might likely happen next. So, for example, 100% retracement, I'm not expecting it to put in a new high. I'm expecting maybe a 30 to 50% bounce. Now, does that mean de facto I can't take that trade? No, it doesn't mean that. It just simply means that my expectations need to be adjusted for that 100% retracement. Right? So if I see 100% retracement, it doesn't mean I can't, take 20, 30, 50 cents out of the trade. It just means I'm not getting $2 or $3 out of it most likely. And if you're okay with taking 30 cents from the trade, then you're probably okay with that trade. But if your expectation is to take $2 out of it, but the chart is telling you I don't have $2 in me, then you can't take the trade. Does that make sense? Now, I know that's a simple concept. You want $2, but the chart giving you 50 cents. You can't take it. But guess what? People do it anyway. And you got to ask yourself, why? Why? Right? I mean, why take a half-court shot when you have maybe a 20% chance of making it, but you think you have an 80% chance of? No, that doesn't work. That's not how good trading works, All right? If you know there's a 20% chance of that thing working and you're okay with that, fine. I don't know why you would be fine, but at least you're objective and honest with yourself. Okay? Yeah, that's what people say. It seemed like a good idea at the time. But that's also people who have FOMO and people who don't use their pre-trade checklist, which is a lot of people because, well, they want to get in the trade. And you guys have heard me say this. It's been a while since I have said it, but I'll say it again. You should always, and I do mean always 100%, always. I don't like to use absolutes, but this time I mean it. You should always be asking yourself or looking for reasons to not take the trade. Everyone's always looking for reasons to take the trade. Oh, it's a bottoming tail. It's bouncing off support. Blah, 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 blah. Look for the reasons not to take it. And if you can't find any, you take the trade. Okay? But that also takes a level of mindfulness, and it also takes some time. You have to step aside, and you can't just jump in everything that you see. All right? So now, we'll talk about the quality and the angle of retracement. So we just talked about the level and depth. Now let's talk about the quality of the angle of retracements. Quality and the angle of retracement, right? So, the steepness of the angle determines the demand. Think about what I said. Read it again. The steepness, excuse me, of the angle determines the demand. In an uptrend, the steeper the retracement, the lower the demand, unless it's climactic. Okay? Now think about that for a second. Think about it. If you have an extremely steep retracement, what happened? Sellers accelerated the selling. People wanted out at any cost, and they were willing to take a huge discount to get out of it. Does that make sense? Or like a run on a bank. Just give me my money now. I know I'm going to take a hit. Just give me my money now. I know I'm going to take a hit. Just give me my money now. Okay? Does that make sense? So when you think of it in that respect or in those terms, all the buyers ran for the hills. The seller's like, out, get me out, get me out, get me out. They're panicking, exactly. Get me out, get me out. I don't care. I'm going to take a 20% haircut. I don't care. 30% haircut. I don't care. Get me out. Get me out. That's it. Right? So when you look at that, that tells us that there is almost no demand or very little demand. See, think of it like this. When you have an angle of retracement that's 30 to 45 degrees, smooth, controlled, you're having buyers and sellers. Like you have kind of an equal marketplace. Does that make sense? Like the housing market. You have buyers and sellers negotiating at reasonable prices. When there's only one buyer and 1,000 sellers, it's a buyer's market. And everyone's doing what? Do you guys remember times, maybe you do, maybe you don't. There were times where people were literally parking cars in their garage and saying, hey, the house comes with the car. Or the car comes with the house, however you want to say it. Remember that? They were doing anything and everything they could to make their house more appealing than their neighbor's house. Oh, the house comes with all the furniture. Oh, I'll pay points, right? Oh, I'll do all of these things to make my house more attractive than your house because the buyers weren't there. Stocks are the same way, okay? So when you look at a stock that is a 30 or 40 degree angle of retracement, you're looking at an even playing field. Buyers and sellers are interacting. Certainly sellers are winning a little bit because it's going lower, but you're buying and selling and buying and selling and buying. It's not just sell, 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 sell. Does that make sense? So buy setups after steep or significant retracement angles have lower odds of working. They fail more often. Now, this is the key here. Of course, it's going to bounce a little bit. It's just not going to bounce as much as you think it will or want it to or need it to. Look, when a stock sells off quickly, it bounces a little bit. It's just not going to put in a new high. It's probably going to do a 30 to 50% retracement and fail. And I always find it fascinating when somebody's looking at a buy setup and I say, I wouldn't take that. I think it's going to bounce about 40 cents and then it's going to fail. And then it bounces 37 cents and fails. And they're like, how did you know that? Are you Nostradamus? No, I'm not. I'm just an idiot. But I know when the retracement angle is too steep, the sellers are in control. And while the buyers might have a small impact and the sellers might take a short break, a short resting period, they're ultimately coming back in. And people are always shocked by this. And I don't know why they're shocked. The angle of retracement told you who is in control. I'm not Nostradamus. I don't make this up. I'm just reading inside the bars. What am I doing? I'm using that empathy that Sophia just talked about. I am looking inside the bars and I'm going, I'm in a room full of sellers. Damn. If I want this stock to move higher, I need to go into a different room. Guess what a different room is? Another stock, not this one. Does that make sense? I hope it makes sense, because that's how you have to think about it. I'm in a room where there's no like-minded people. And guess what? I need like-minded people for a stock to go higher. I can't raise Microsoft by myself. I need me and thousands of other people to feel the same way. And if I'm in a room where I don't see many like-minded people, I have a problem on my hands. So I need to leave that room and go to a room where I'm like, okay, there's more buyers in this room. I hope these analogies work for you, because I'm trying to use layman's terms to describe the way trading is. Okay? So a substantial change in the angle of a direction often ends a move. So you may have a stock that's pulling back nice, 30%, 40%, and then boom, a wide range bar comes in. That often kind of ends the pullback, but it doesn't also mean that you're going to put in a new high on the bounce either. You likely will not. So the angle of an ideal retracement is roughly 30 to 45 degrees. Sequential lower highs and lower lows, substantially overlapping bars are not ideal. Substantially means more than 50%. I'll repeat. Substantially means more than 50%. Now, obviously, ideal overlap is in that 20 to 30% range. But you really don't want to see 70% overlap, 80% overlap. It's not what you want to see. There's a battle being fought there, and you don't really want to see a battle being fought, okay? Quality pullbacks are tight, not overlapping, and they aren't whippy either. They're more predictable and thus more reliable, and more reliability typically means more money, typically speaking. Okay, so now that we've gone through that, all right, now we're going to look at some charts and discuss it. And the next chart I'm going to spend some time on, all right? Excuse me. So this is an important chart, right? There's a lot of charts that we go through these lectures, through the years, through PTS. And this is one of the more important charts that we look at. I really like the chart because you don't get too many examples this good. Does that make sense? So, angle matters is the name of the chart. Higher highs, higher lows, clear uptrend, etc. Let's start with the basic picture first. Basic picture first. What I have here is a stock that is going higher with higher highs and higher lows, okay? Right? What I have here is a stock with higher highs and higher lows, okay? Riding the 50-period moving average. So overall, when you look at this, you're looking at a trend that looks pretty solid. But we're not after that. We're after when will it end? When will it begin? Those are the two things that every trader wants to know, right? Don't we all want to know when a trend's going to start and when it's going to end? Isn't that kind of the $64,000 question of what we do every single day? When's the up move going to start? When's it going to stop? Right? And that's really the most important thing we do. So let's take a look. We start at the bottom left, okay? And we can clearly see that there was some type of gap down or some type of large move lower, because I can see that this moving average is trending lower, okay? Then it bounces, pulls back, and we kind of have, I don't want to call this a retest, but you can start to see that the moving average goes sideways and then a little bit higher, sideways, then a little bit higher. Okay? Bottoming tail here, up, 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 sideways up, pull back up, pull back up, pull back up. Great. Now it's time to get more granular. We know that the moving average went from down to sideways to starting to move higher. That's great. We know that these 5 green bars here put in a higher pivot high. See the pivot to the left? That's good. And when they did this, they also pulled away from the moving average. We all know that the moving average acts like a magnet. When a stock gets too far away from it, it gets pulled back like a tractor beam. It gets pulled back towards the moving average. And there are 2 ways that can be done. Through time and through price. There are only 2 ways that can be done. Time and price. In this particular case, the first, quote, pullback was not actually a pullback. It was a correction through time, right? See it right here? Sideways, 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 sideways. Note, it was far from the moving average. Now it's much closer. What does that tell us? We don't have to touch it, but when we get close to the moving average, that's a sign, a signal that the stock has rested long enough and it's ready for the next move up. That's what that means. When we get close, doesn't have to touch it, when we get close to the moving average, it's a sign that we're rested long enough that the stock is ready to move on. Guess what? We consolidate for 2, 4, 6, 8, 10, 11 bars, 10 bars, whatever, and we move higher again. We put in a nice new high. And note, while, to be fair, while the overlap here is a little more than I'd like to see, the angle of the retracement is quite nice. The location of the retracement is quite nice because if we draw this out, right, we're kind of sitting in that area, right? So we're in an area where, remember, the ceiling over here to the left, the ceiling becomes the floor. The sellers up here now become the buyers. So we break through the ceiling, we pull back, and the new floor is the old ceiling, which is higher. That's a good thing, okay? So we have that pullback. We're at or near the rising moving average. We're probably at about a 40-ish% retracement. Now, is this the cleanest pullback? No, there's topping tail, topping tail. Here's kind of a trigger right there. But what is still intact? Talk to me. What is still intact? It's the most important thing we have right now. What's still intact? Talk to me. One word answer. What is still intact? Think about it for a second. Yes, Brent, Vermin, Sophia, Ben, Kirk. Yes, the trend and the trend line is still intact. And that's the most important thing we need to see. See, entries, okay, we'd like them to be perfect, but my bias is more important. I'm going to say it one more time. I'd like my entries to be near perfect, but my bias is even more important. Because without a strong bias, your entry doesn't much matter. Because it's not based off of a higher time frame trend. And that's what you need to make money. So, our trend is still intact. We're putting in a higher high and a higher low, and a higher high and a higher low. We're riding the trend line. We're riding the moving average. We're holding areas of support. We're not overly extended. There's no wide range ending bars. Like, we're good. So then the stock gaps up and moves higher. Okay? Pretty significantly moves higher. And once again, we get really far from the moving average. And like a magnet and a tractor beam, it pulls back towards the moving average. Okay? Now remember, guys, I want to be clear about something. This chart could be any time frame whatsoever. So you might go, geez, Jared, I don't know if that's a good enough buy setup. Well, what if it's a daily chart and it gaps up and this bar right here is a daily bar, and I can drill down to a 5-minute chart and find a better entry. I see that little bottoming tail on the daily bar. I buy the pullback to support, right? Let's do it right here. Right there. See that right there? Let's make it like orange or something like that. Right? What if this is a daily chart? Excuse me, and it most likely is. And all of a sudden, we gap up, and right in the first 10, 15 minutes of the day, this thing pulls right back to the orange line. And that orange line is a buy setup at the prior pivot high. And you have an entry. And boom, it does that for the rest of the day. That, okay, that is professional trading. That's how it's done. Okay, CVNA was probably a good example of that today. Okay, so moving along, the stock moves up, 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 gets far from the moving average, like a tractor beam, does a correction through price, and it pulls back. Now note, the angle of retracement here is very similar to this angle, right? Almost the same. But again, once again, a little bit of a sloppy pullback, but our trend is still intact. Still have higher highs, still have higher lows. We're still on the trend line. We're still above the moving average. Check, 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 check. The most important things I need and want to see are still happening. Then we get two more wide range bars. Okay. Put in a higher high and a higher low. Now this is where we need to start having conversations. Yes, it's a higher high. Yes, it's a higher low. Yes, the overall trend is still intact. However what? However what? Give me some problems here. There's 2 or 3 or 4 issues here. Now, I'm not saying it's the end of the world. I just want you to tell me what are some things that you have noticed here about this pullback that are different than the last 2 pullbacks. Brent says angle of retracement. Good. It's steeper. The angle is definitely steeper. That's one. There's like 3 or 4 things here, guys. 3 or 4 things. The angle is steeper. Good. What else? What else do we see? More than a 50% retracement. Okay, so the level and depth, the depth of retracement is also more concerning. No, it is not 100% retracement. Brent, to be clear, Brent, 100% retracement is down here. Okay, here, let me do this again. 100% retracement would be there. Okay, that would be 100% retracement. Okay, so it's not 100% retracement. Okay, but it is deeper than the other retracements. So one, the angle is steeper. The level or depth is deeper. Okay, what else? It broke the moving average. Good, right? It broke the moving average. Good. Technically, we also broke what? Hint. Oh, Yaroslav has it. We broke the trend line. Okay? Jordan, 4th leg of the move. Let's type this in. Seriously, you guys got to understand this. So, angle is steeper. Okay? Next, depth is deeper. Okay? Next, broke the MA. Okay? Broke the trend line. Okay? 4th move. I should just say 4th pivot of the move. There's one more thing you guys aren't talking about. Okay? And it did break support. True, right? Broke minor support. Okay? Broke minor support. So we have angle is steeper. Depth is deeper. Broke the moving average. Broke the trend line. 4th pivot of the move. Broke minor support. And what else? There's overlap. Okay, Martin, we can go with that. But the other 2 pullbacks also had overlap. There's one more thing here. One more thing here. I don't think anyone got it. Let me double check. Okay. Nope, I don't think anyone said it. Okay. No, we already talked about the moving average. We already talked about that. MA means moving average. Okay. Oh, trade slasher. Bam! 97X. Future of rock and roll. That's it. Thank you. Thank you for paying attention. The new high is less significant. Less significant. Okay, let's continue to do this. We have here, orange. Here, orange. Here, orange. Do you guys start to see, and I should do this also. Okay, hold on. They're orange. Okay, see the orange lines. See the orange lines. See the difference between this orange line and this orange line. Then this orange line and this orange line. And then this orange line and this orange line. We're starting to see momentum is slowing down. We know this because the new pivot high is less significant. Trade slasher. On the money, man. On the money. This new high is the least significant new high of the move. Buyers are starting to get a little tired. Starting to run out of steam a little bit. Okay? And then let's go one step further and do it one more time. And the same thing is happening up here. Right? This new high is, again, starting to get a little weak. Moving on the pullback. 80% pullback. Choppy? It's actually not a choppy pullback, but the angle of retracement, terrible. Super steep. Level and depth of retracement, super deep, 80%. Broke the trend line, broke the moving average. In fact, when we started this whole move, that's pretty much where we are. Give or take right about there. Let's make that a different color. Let's make it, I don't know, blue. I know there's too many lines on here right now. So note the last two pivots have broken the trend line and the moving average. And they're putting in weak new highs. And the angle of retracement is steep. And the level of retracement is deep. And. This is cause for caution. It's caution. Be careful is what the stock is saying. I am getting tired. Please be careful. If you want to scalp me for 20 cents, great. But if you're expecting a big move, I am not your guy. I'm not your girl. I'm not that person. Because I'm tired. Right? Let's take all this off. Dun, 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 dun. There. Okay? Does that make sense? Give me a yes or no, Y or nay. What we just talked about on this slide, does it generally make sense to you? The concepts, does it make sense to you? I need more than one person. There we go. There we go. Good. All right? Because this is how you have empathy. You're thinking, what is the stock telling me? I need to look inside the bars and inside the trend. And when I dig deep into the bars and the trend, it's telling me, it's speaking to me, communicating with me, saying, I was strong for a while, the first 2 or 3 pivots, but the last 4th and 5th pivot, not so much. Wink, wink, between you and I, stay away, stay away. If you're already in the trade, great. If you're already in the trade, just ride it up and keep raising your stop. Ride it up and raise your stop. But you know you're getting topsy. If you're not in the trade, do not take the 4th or 5th buy setup. Take the breakout here, take the buy setup here, and the buy setup here. 3 entries. The 4th and 5th one, careful. Careful. And guys, I want to be clear. Sometimes the stock will still go. This wide range bar for me right here, see this massive green bar? That was unexpected. Oh well, we're odds traders. We're not perfect traders, we're odds traders. There are going to be times when a stock defies logic. Hence the terminology, the market can stay irrational longer than you can stay solvent. Because sometimes the market just does completely unexpected stuff. We're not after the unexpected stuff. We're after the expected stuff. I'm going to say it again. We are not after the unexpected. We're after the expected, because I can predict the expected. I cannot predict the unexpected. We have stop losses for the unexpected. Okay? Now, I know I spent a long time on that slide, but I do every time I talk about it. All right? So, quality of pullback. Note the overlap on the left. Not so much, not so big, not so great. That's good. That's good. Why? Because there's no battle on the pullback, so there shouldn't be a battle on the way back up. Over on the right-hand side, the problem that we're having, and this is, I think, sometimes confuses new traders sometimes. The problem on the right-hand side is that we are having a battle, and the buyers are losing. See, over here, there was really not a big battle that took place. The sellers just came in and cleaned house. So what this means is almost all the sellers that wanted to get out got out. So when the buyers do come back, there are very few sellers to overcome, to sell into, right? On the right, the buyers put up a fight, big fight, and the sellers still won. That's a problem. Because now you've eliminated a lot of the buyers on the way back up. And the sellers have also let you know, we're in this one for the long haul. I'm going to fight you every step of the way, tooth and nail. I'm going to fight you. And I don't really want that. I don't want a relationship that I have to fight every day in. I want a relationship where we get along. That's it. Nice job on Sedge, guys. Okay? So the overlap into the prior bar should be minimal, 20 to 30%, not more than 50%. Okay? Now, take a look at a real chart. We move up on the left-hand side and we pull back. We move up, we pull back, we move up, we pull back. Now, the green box is a relatively tight move up. Okay? Sequential, sort of, right? I mean, there is a bottoming tail. That bottoming tail kind of messes with us a little bit, right? The bottoming tail. But without the bottoming tail, you kind of have a sequential pullback, right? Lower high, lower high, lower high. The angle of retracement is definitely a little bit concerning. But if you took the top of the pivot to the bottom of the pivot, it's about 50%, right? It's about 50, top, bottom, about 50. And again, the bottoming tail throws us for a little bit of a loop, but otherwise, in the real world, that's a relatively sequential pullback. And then you get a wide range green bar that engulfs the red bar, and that becomes the entry bar. And because of the sequential pullback, the move back up is pretty good, right? Moves up, gaps down and bullies, goes higher, okay? But here's the problem. Now, the second move, the red box, note the pullback. It's just overlappy slop. I mean, 100% overlap, 80% overlap, just all kinds of overlap. Not only is it overlapping, the pullback goes below the minor price support, right? The minor price support is right there. And it goes significantly below that. And surprisingly, it bounces pretty good. It's a choppy bounce, but it bounces pretty good. Okay? And then the shit hits the fan all the way on the right-hand side. Okay? What about the volume on the first pullback? What about the volume on the pullback? What about it? What's the concern, Xavier, that you have? I want to see some of this volume. You know why? Because if I see that level of volume and I see a red bar, what am I assuming? Anyone who wanted to sell it sold it. There's a high volume of sellers here, and that for me means they're, well, for lack of a better term, blowing their load, right? They're getting out. And that means when they've all finally gotten out, the move back up should have less or fewer sellers to sell into me, right? So not only do I see some extra volume here on the pullback, but I also see good volume on the bounce. Right? I also see good volume on the bounce. Where I'm going with this is one is better than the other, but more importantly than that, I want to show you the red box too because sometimes the sloppiest trades in the world still work. But it doesn't mean you should take them. Note, it says a less reliable buy setup. It doesn't say it can't work. It just says less reliable. I don't want to buy into this garbage. Guys, don't get me wrong. Everything has an exception. I mean, if the market was tanking climactic and this stock was bouncing, I might consider it, even though it's sloppy, because I'm looking at so much relative strength, it's ridiculous. But in a normal market environment, I don't really want to see this type of overlapping pullback. Now, to be fair, it's still holding the trend line. It's still putting in higher highs until, of course, the right-hand side where it just gets ugly. Where I'm going with this is a real-world chart, and I don't really want to buy it. It's just very sloppy on the overlap, okay? What you want to see, because this is also a real-world chart, is this. You want to see a stock that's moving up nicely and sequentially, okay? Riding the moving average, riding the trend line, putting in higher highs and higher lows in a nice smooth manner. So take a look at that pullback. We got too far from the moving average, right? Initially, the stock broke out. Take a look at broke out there, okay? Bounces up 4 bars in a row. Gets too far from the moving average. Like a magnet, gets pulled back into the moving average or towards the moving average. Take the pivot high. Take the pivot low. You're about 50%. Take the pivot high, 37.80-ish. Pivot low, 37.10-ish. 70 cents. And you're right around what? 37.40, 37.45. It's right almost smack in the middle. Okay? Look at the overlap. Very minimal overlap here. Your entry bar is the green bar. Your stop loss is here. And I always recommend giving them some room. Give them some room. Give them some room. Give them some room, please. Don't put it a penny under that bar. Put it 20, 30, 40 cents under that bar. Obviously, it depends on the stock. This stock, you can't give it 40 cents. That's too much, right? But you get my point. Give them a little wiggle room. Okay? You know what's a good example of that? Tesla today. Jordan was right about Tesla today. But our timing was a little bit off. We were about $1, $1.50 off, weren't we? That's what it took. Our stop was 264.50. It went to like 265.50 or somewhere around there, give or take, right? We were $1, $1.50 wrong. And then it worked. Thankfully, we got back in. Thankfully, we got back. My point is the concept was correct, but the timing was a little bit off. And sometimes it's the same with beautiful patterns. Sometimes the concept is perfect. Even the pattern is perfect. But every once in a while, they shake the tree and then they work. Give them a little bit of room. This is what you want to see in an uptrend. This is what you want to see in a buy setup. Something this clean, this pretty, this beautiful. Let's keep going. Pullbacks. Look to the left. Look to the left. We have a stock that went a little bit sideways. It bounced up, pulled back, bounced up, pulled back. Get married, Jordan. You think your life will be, you'll just be walking in circles every day. You're like, man, trading's hard enough. Then I got married on top of it. What have I done to myself? Right? Then you really want to screw yourself? Throw some kids in there. Anyway, back to the point at hand. Okay. Just kidding. Just kidding. It's all peaches and cream. You have a stock that went sideways, bounced, pulled back, bounced, pulled back. So we're breaking out of this range. When we do, I want you to note the pullback here, nice sequential pullback, and where does it stop? Let's put some lines on here, okay? Hold on, let's do this. Right here. Let's make it orange. Okay. Where's our pullback happening? Right there. Beautiful. Beautiful. Wait for it. Where's our pullback happening? Beautiful. Right there. Okay? Even this last one, even though it's not perfect, actually pulls back to support. And one more thing, let's not forget this. Let's go right about there. Right about there. Let's make that pink. I know it's a lot of lines, guys. I know. And I hope you can see through the lines because I don't like spaghetti charts, but I think it's important. So now we have a stock putting in higher highs, higher lows, bouncing off of support, having sequential pullbacks. The angle of retracement is quite nice, right? The new highs it's putting in are nice, significant new highs. I mean, this thing's looking good. It's riding the pink line, which is the trend line. I mean, not bad. And then it does this. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 bars up. You have to know, after 10 bars up, and it's the third, I guess you could say maybe the second or third. 1, 2, 3. It's really the third move, okay? You have to start questioning things. So now you're super duper duper far from the moving average, super far from the trend line, okay? This stock's tired, man. Take your money and run. Who wrote that song? Take your money and run? I can't think of it. Anyway, pulls back and bounces. You don't really want anything to do with this anymore. After this move up, once we get kind of past this orange line, right, and you go 10 bars up, trail it out. Trail it out. Now, if you want to put your stop loss under this bottoming tail bar, let me put a line on it, okay? If you want to put your stop loss under that bottoming tail bar, fine. And that big red bar comes in and flushes you out, okay? And flushes you out. That's it. I really don't want to buy this stock at $35. It's too extended by this point. Okay, and note, it's gone from 15 to 35. It's quite a move. Yes, it did go higher. I get that. It did. But I don't want to buy it at 35. It's too extended. On this pullback, I don't want to buy it at 35 on the buy setup either because it's too extended. And what happens? It fails, and then it rips. Now, this is exactly where I used the comment a couple slides ago. The market can stay irrational longer than you can stay solvent. This move from 30 up to 50, completely unexpected. And guess what? I don't care. See, a lot of you guys have FOMO. You're like, yeah, but Jared, it went up $15 more. So what? I can't predict that. I'm not Nostradamus. I'm not Nancy Pelosi. I can't predict that. I only want to deal with things that I can reasonably predict. Everything else doesn't matter. The reason I'm telling you guys is like 14 times today is there are a lot of traders that have FOMO. I want to take that out of your vocabulary for trading. I want you taking things that you can easily predict so you can come in and make $506 today. Sophia, good job today. Right? So you can come in and make $5,000 today, $10,000 today. And you know what I can predict? I can predict this breakout. I can predict this buy setup. I can predict this buy setup, and I can trail out that buy setup because it's the third leg of the move. I can't predict the move from 30 to 50 over here. And if I did, it would be dumb luck. I'm not interested in dumb luck. I'm interested in what I can predict. Sure, I'm okay with getting lucky once in a while. If you're married, not often, right? But I mean it on a serious note. I want to only trade what I can easily predict. Everything else, that's for the birds. If you take it and rub it in my face, I don't care. I can't predict that. Does that make sense? And this, people ask sometimes, well, how do you become a consistent trader? You take things that you can consistently predict. Does that make sense? You don't take things you can't predict. If you can't predict it, you shouldn't be taking it. Now, I understand that's a dangerous thing to say because some people go, well, I could predict that move over $30, Jared. I could. No, you can't. No, you can't. And if you said you could, you're just lying or just don't know what you're doing. One of the two. We want things that are repeatable. Things that are repeatable is the only thing that matter in trading. That's it. Okay? Things that are repeatable are the only things that matter in trading. Let me take one of these real fast. Hold on. There. Okay. Now, it's the same damn thing. It's just in the opposite direction. Okay, so now, let's turn this over. Just look at it like that. You make that orange again. We take a look at this. It's not perfect, but what do you really have pretty much right there? Again, not exactly perfect, but you have pretty much what? A down trending channel. Okay? And it happens after this. Right? I'll make that green because that was the support area. Okay? This was the support area of a stock that was moving higher. I know it was moving higher because the moving average was going up. And then it chops around, double bottom retest, bounces, tries to do a turnaround bar, tries to bounce and fails. Ooh, that's nice. A failed breakout at 39.60. No, I'm not going to short it at 39.40. I'm going to wait till it breaks support. I love the fact that it's failing the breakout here if you're short biased, But I'm not actually going to short it until it gets under 39.30 and gives me a pattern. Well, it does. It breaks 39.30. And by the way, I like to kind of tie things in. There are breakouts and there are tradable breakouts. Well, in this case, there are breakdowns and there are tradable breakdowns. This is a breakdown. Do you see this area right here? This 1, 2, 3, 4, 5 red bars. That's actually a breakdown. It's not a tradable breakdown. The tradable area is the sell set up here, the sell set up here, and the sell set up here. That's it. Some people will short this right at 39.30. Go, oh, but it's breaking down. That's not a breakdown. You're shorting something that's 4 bars into the move already. And what happens? It goes a little bit lower and bounces back up into overhead supply or resistance, where it should, leaves topping tails under the declining moving average, under the trend line, and then tanks. And does it again, and does it again. This is what good trading looks like. Bam. All right. Got that off there too. Oh, one more. Okay. Next slide. Considerations. Here's a stock that moves up, pulls back, gaps up, pulls back, moves higher. So, smooth move lower, smooth pullback, not much overlap. Angle of retracement is reasonable. I don't know why this line is here. Sorry. Not sure what that was doing there. Okay. So, I would agree with most of this assessment that there's little overlap. Okay. Angle of retracement is reasonable. Ooh. Maybe. This last bar kind of puts a kink in the works, doesn't it? So what do we do here? Let's talk through this one. I'll give you some help. Okay, again, maybe not in the exact perfect area. Okay. How are we doing? Good, bad, ugly? What do you think? Talk to me. Talk to me, Goose. What do you guys think? Talking specifically about this buy setup. Good, bad, mediocre, great, terrible? What you thinking? You like it? You hate it? Good except the angle. Okay. The angle is a little bit concerning, right? The angle is steep. Is the angle deep? I don't think it's deep. Right? And take the top, take the bottom. I don't think the angle is too deep. I think it's in that 50% range, 40 to 50% range. Okay. The biggest, for me, the biggest concern I have is this last red bar. Everything up until this point actually is pretty good, right? I mean, when you look at a stock that gapped up, pulls back, and immediately fires up. I mean, this thing just goes. That's strength, right? Gets far from the moving average and starts to pull back. That's fine. This last bar tends to be a little concerning, right? So, while overall, I like it because I like the strength of the move from the bottom. See this thing pulled back to 48.80, 49, whatever that area is, and it just ripped. See these two red bars early in the day, the second bar of the day, the third bar of the day, they were taken out like a hot knife through butter. Like, here, hold my beer. That says something about this stock. Okay, the fact that they were immediately engulfed and taken out. And they didn't just peekaboo to a new high here at 49.60. They went all the way up to 50.10. Buyers are showing me something right here. And buyers, what they're showing me is we're strong. So the first three bars of the pullback are pretty damn nice. That's what you want to see. This last bar breaks 49.60, and I think that's where the concern starts to come in. Right? People, if this thing stopped at 49.60, I think some people would be like, yeah, this thing's great. But then we have to look at the flip side. Bigger picture, right? Bigger picture, the trend is still intact. We did put in a higher pivot high and a higher pivot low. It is at the moving average near the trend line on a 40 or 50% retracement. And as long as the market environment is not terrible, I don't see a huge reason not to take it. Now, am I going to give it some extra wiggle room? I would, yes. I would give it some extra wiggle room. But I don't see any real reason not to take it. Now, again, I still have to review the 60-minute and the market. But in a vacuum on this particular chart, yeah, I think I'm okay. I think I would take this. All right? Now, last major slide for you guys is this. Man, I've been dragging out these lectures lately, haven't I? Hold on one second. I messed something up there. There we go. Okay. All right. Last major slide. There's one more after this, but good buy setup, good buy setup, good buy setup. Ooh, baby. Let's start with the first one. What you think? Good? Mediocre? Bad? If we start to the left, we have a lot of narrow range bars on low volume. Then we have a wide range green bar on volume. And then narrow range slop and a wide range green bar, followed by a wide range green bar, and we pull back. So you guys think the first buy set up somewhere around $11. Right? Somewhere around $11. Give or take. I have good, good, good. That y-axis is insane, bad. I'm curious for the goods, Sophia, Derek, Greg. What do you love about it? Now remember, okay? Remember, good thing to do. Always do this, right? It's always good to do that. Okay? It's very interesting, isn't it? Lots of overlap here. We're riding a trend line. We're riding a moving average. But we cannot ignore topping tail, topping tail, topping tail, topping tail. The red bar here got engulfed by a green bar. But then the next bar is a red bar. How do you know? I have a hard time with this one. KL, I'm with you. I want confirmation. So, I'll tell you, if I took this, I would wait for $12. I'll tell you why. We have 3 topping tails followed by a wide range red bar. That's bearish no matter how you slice it. That red bar was then engulfed by a green bar, which is bullish. But after that green engulfing bar, the next bar is red. So how do you know at that moment in time who's winning this battle? You don't. You don't. Because realistically speaking, Over the last 1, 2, 3, 4, 5, 6, 7 bars, out of the last 7 bars, you really only have one glimmer of hope, and that's the one green bar. Right? You really only have one little glimmer of hope, and that's the one green bar out of the last 7. And out of one green bar out of the last 7, you're all going to go long? You got balls. Big brass ones. I want more confirmation. For me, I want more confirmation. So for me, it's got to at least be $12 or more, probably 13 or 14. There's always another trade out there. Always another trade out there. Okay? Now, same thing on the second one. Rips from 10-ish to 24. Yeah, this is nuts. This stock went from $8 to like 35 in one day. Okay? Goes nuts. Just this bar goes from 18 to 24. Okay? Chops around, chops around, chops around, chops around, triggers a buy setup. Lower high, lower high. It's technically not a buy setup because it only has 2 lower highs and not 2 lower lows. So it really should not really be called a buy setup. But we're really far away. Choppy overlap. Now remember, you don't know the future. You have a stock that just went from 8 to 24. The answer is no. I'm not even going to ask for your opinion. The answer is no. Stock that just went from 8 to 24, super far from the moving average, has a big-ass red bar, and just because it puts in a tiny little bottoming tail, you want to go long on it. No. Don't do it. And if you can't go long on this one, you most definitely can't go long on the last one. Wouldn't do it. So for me, while this chart did go from 8 to 35, if I'm being honest, I don't know that there's anywhere I would have bought this thing. Maybe on the initial breakout right here at like $9, maybe, right? Maybe. But there's really nowhere in here that I can legitimately say I would have bought this stock. If this wide range bar at 14 set up a 3-bar play, then I might have a different conversation. But I can't honestly tell you that there's anywhere on here that I would have bought this stock. And I know what the future brought. So no, I wouldn't probably have taken any of those. All right. Let's wrap this up. Common reasons trades fail. Poor quality trends, without a trend, and against a trend. We can talk about patterns, but we always talk about bias first. Bias comes first. 60-minute daily bias comes first. A poor quality trend, no trend, or against the trend. Okay? High quality trends are tight and controlled with little overlap. We saw that on those 2 slides. Okay? Low quality trends are often whippy, spready, and have a lot of overlapping bars, and they're very hard to predict. Just like that last chart we saw. So it was actually hard to predict. I know it went from 8 to 35, but it was still hard to predict. To be a good trader, you have to be able to accurately define trends and then have the patience and discipline to only trade the high quality, more predictable trends. I want you to read the underlined part again. Have the patience and discipline to only trade the high quality, more predictable trends. FOMO is a powerful thing. I get it. But it's going to get you in trouble. There's always another trade. And if for some reason you can't find another trade, just wait till tomorrow and another trade will appear. Stop with the FOMO garbage. You are a pattern trader, and your job is to find patterns that you recognize that you can reasonably predict. You will not be right all the time, and that's okay. Not patterns that you're taking a flyer on that you're like, well, I kind of think it sort of looks okay. No. Patterns that you can reasonably predict with a relatively high accuracy level. All right, so I hope you guys learned a little bit more about angle of retracement, level and depth of retracement, and quality of retracement today. And I hope that you'll apply some of these concepts to your own trading so that you'll become a better trader and a more predictable trader and hopefully a more profitable trader. I'm Jared Wesley of Live Traders. We'll get back at it again next week.